All right, today we're breaking down the Q2 earnings call from EyePoint Pharmaceuticals, ticker EYPT. And let me tell you, this one is fascinating because on the surface, it looks like a pretty clear miss. But if you dig just a little deeper, there's a completely different and frankly, a much more bullish story playing out. So let's get right into it. You know, the whole quarter for EyePoint can really be summed up as a tale of two very different reports. You had the financial report, which, yeah, it definitely caused some nervousness out of the gate. But then you had the operational report, and that's where management and the smart money is really putting all of its focus. And you can see that disconnect right here. On the financial side, yeah, clear misses on both revenue and earnings. No way around that. But then look at the operational side of the ledger. It's just a string of major wins. Phase 3 enrollment complete, their commercial facility is officially online, and they've already started key manufacturing batches. So the real question is, which one of these stories actually matters more? Let's start with the numbers that initially spooked the market. Okay, first up, let's quickly cover the financial figures that drove that initial knee-jerk market reaction. These are the numbers that hit the wires right after the 8:30 a.m. call. So looking at the raw numbers, you can see the miss pretty clearly. Revenue came in at $5.3 million, which was short of the $6.6 million consensus. And on the bottom line, the official loss per share was 85 cents, just a little wider than the 82 cents analysts were looking for. Now, this was almost entirely driven by a planned and necessary ramp-up in R&D spending for their huge Phase 3 trials. And the market's response was, well, immediate and totally predictable. The stock dipped about 4.5% in pre-market trading. It was a classic reaction to a headline miss. But that dip, well, that's not the real story here at all. Now, let's pivot to what I think is the real narrative this quarter. And it's all about execution, not short-term financial optics. This is the theme that management spent the entire call hammering home, and for good reason. This quote from the CEO, Dr. Jay Duker, it just perfectly frames the company's entire mindset. He's making it crystal clear. They are not worried about the accounting details from a legacy business they've already moved on from. No, they are laser-focused on hitting the critical clinical milestones for their lead drug candidate, a treatment called DURAVYU. And the proof is right there in the numbers. They enrolled over 800 patients across 2 massive trials in just 7 months. I mean, that speed is just incredible. Management sees this as a huge signal of massive demand from doctors who are crying out for a better therapy option. And it's not just about enrollment. They hit other absolutely critical milestones, getting their commercial manufacturing facility in Massachusetts up and running and starting those registration batches for DURAVYU. Those are huge de-risking events. This tells you it's not just a clinical science project anymore. They are actively building the machine for a full-scale commercial launch. Okay, but you know what they say. All that R&D spending costs a lot of money. So a fair question is, how's their financial health? And how are they actually stacking up against the rest of the struggling biotech sector? Well, despite that increased spending, they ended the quarter with a very, very healthy $256 million in cash. Management was emphatic that this gives them a runway all the way into 2027, which pushes them well past their major data readouts. What that really means is they don't need to go back to the market to raise money anytime soon. That's huge. This chart right here really tells the story of how the market has been rewarding that execution. While the broader biotech sector, which you can see represented by the XBI fund, has been underwater for the last year, EyePoint is up significantly. It's a clear signal that long-term investors are valuing this clinical progress way more than one quarter's financial results. All right, so with that context, let's shift our focus to the future. What are the key events that investors really need to be watching from here? Here's the roadmap. Later this year, we're going to get an update on their Phase 3 plan for another indication, diabetic macular edema, or DME. But the main events, the ones everyone's waiting for, are in 2026. We've got top-line data from their first pivotal trial called LUGANO, expected mid-year. That'll be followed by the second trial, LUCIA, in the back half of the year. Make no mistake, these are the major binary events for the stock. So given this kind of mixed report, a financial miss but an operational home run, what did Wall Street actually make of it all? Did they focus on the miss or did they focus on the execution? Well, the reaction from the analyst community was actually pretty constructive. Mizuho, for example, they looked right past the quarterly numbers. They maintained their Outperform rating and actually raised their price target to $28. And their reasoning was all about that program momentum and the significant de-risking that comes from completing enrollment. They see the big picture.
All right, now for our take here at Talk Tickers. Based on all of this, how do we see this playing out heading into the next quarter and beyond?
So here's our prediction. We think the stock will likely trade in a range for a bit, probably until we get closer to those big 2026 catalysts. The key variable we'll be watching is patient retention in the trials. Right now, management noted a dropout rate of under 2%, which is just excellent for the trial's integrity. So, you put it all together, strong execution, solid cash position, and a very clear catalyst path. Our rating is Outperform. So, what's a potential trade idea here? Well, with the huge binary events slated for mid-2026, the key variable is really just time. So an interesting approach could be to look at long-dated call options, maybe with an expiration date out in late 2026. This strategy lets you capture the significant potential upside from a positive data readout, while at the same time clearly defining your maximum risk right up front.
And of course, we have to say it loud and clear, this is not financial advice.
So to wrap all this up, the market initially sold off on the headline numbers. But when you look at the incredible operational progress and the de-risking that's happened, the real question you have to ask yourself is, did they completely miss the actual story?